Hello, I'm Donald Leggett, and welcome to the latest London South East CEO interview. AIM-listed One Media IP Group have just released full-year results for 2020. Financial highlights include a strong set of numbers and a successful share placing during the year. Operational highlights include separating out One Media's anti-pirating service TCAT as a separate entity. Michael Infante, the CEO, is with me today to discuss all these things and more. Welcome, Michael.
Thank you. Nice to see you.
Let's talk about the results first, Michael. So what kind of a year has it been with COVID? Did your music business model prove to be resilient?
Well, yes. I think the results reflect exactly the kind of year that we've had. It hasn't been easy. It's been a very tough year, not just because of the pandemic, but I think of all the challenges it's brought our industry, let alone just One Media. We've seen very much the collapse of live entertainment. We've seen all of the live side for the artists and performers really much disappear. One Media is not involved in that part of the industry. We're very much a frozen in time business. We acquire music from the 50s, 60s, 70s and 80s. That's our sweet spot. And we deliver that through the many digital stores such as Amazon, Spotify, Apple, all the usual suspects, to 167 territories globally. Clearly, during the pandemic, people have been at home. There's been a minor uplift in streaming in terms of music. It wasn't as big as I think everybody thought, because what we lost was the daily commute when people were going to work and had their hour either way. And then that was picked up by, I think, the home readjustment globally, not just the UK. The interesting thing is certain sectors that we've seen music perform well. One Media has a very widespread eclectic mix of product. We're genre non-specific in terms of we cover children's, pop, rock, we got classical. We've seen an uplift in classical music. We've seen an uplift in children's music. So I think there's been a feel-good factor about people going back to better times in terms of memories when it comes to delivering music, and we're well equipped in our libraries to cater for that. So to an extent, I think that the way the industry is shifting and moving, it has proven robust in these tough times.
Okay, let's turn to your numbers. You've delivered a strong set of numbers, as we explained at the top of the interview. What stood out for you? What were the standout points you'd like to make here?
I think really, as we entered the pandemic, when I was looking at our forecasts a year ago, and we entered into the world of lockdown, I think I'd have been happy to see a sort of plus or minus 20-25% position. None of us knew, none of us seen what was going to happen. So for us to deliver sort of on the button, for us has been a very strong point. And I think it just goes back to the smart way that we've been buying music. We pick up, as I say, nostalgic product that people will go back to in times of happiness and times of sadness. That robust feeling of recurring income is what we're doing. We don't invest into new bands and new performances. So, as I say, we weren't affected by the live performance side of things. And we're risk adverse when it comes to investing into products. So we don't, as I say, back new bands. It's not what we do. There's plenty of labels that do. We're more about buying content of the past.
So nostalgia has actually proved resilient in lockdown. That's what you're saying, essentially.
I think nostalgia proves robust and resilient in our lives regardless. We all have a time when we look back and play older music. We may play a little bit more in times of joy and times of sadness. But at the end of the day, that's our stock and trade. That's what we trade in.
Okay, and digital anti-piracy service, TCAT. Let me unravel that a little bit more. It's something which, as I understand, you've been developing inside the business, and now you're taking it, you're turning it into an independent subsidiary. Tell all.
Correct. So we've been working for the last 4 years on enforcing our own rights, and TCAT, Technical Copyright Analysis Tool, has been working to enforce our own rights. So what it does is it allows us to look at the legitimate stores where music is being used to ensure that products have been delivered and to ensure that we're in every territory. So it's an audit tool as much as anything else. What we found over the last few years is that we presented this to major record labels and the world's largest distributors, and we've said, can we do a service for you? So we've been working hand in hand with them with development. And now we've got to a stage where we've proved the model. We need to take it out of the core business. We now have 8 or 9 chaps and very, very clever more PhDs than most universities, rather than have just working in our business now. So we've seen this the opportunity now to separate it, put it as a separate model, because it is different to the core business of what we do. As I say, it's a very strong, robust audit tool, and to give it its own life. So we announced that back in November. We will be ramping that up, and we will be expanding the TCAT service. It's a year in development at the moment under its new auspice. We still own the majority share in it. Over 90% is still held by us and 10% by others. And we would look to expand that out and offer that out as a separate service, if you like, to the way that we do our normal content buying. So it is very much a Chinese wall between the two businesses.
What are the benefits, though, of spinning it out, as you say, of separating it out? Why?
It gives it its independence. Now, bear in mind that we're content acquirers, and we will be competing against our colleagues in the music industry. This is a tool that can serve all. So we think it needs to have its independence so that it isn't seen as conflicted.
Okay, good answer. Okay, let's turn to your share placing in August. What was that share you raised? £6 million, a fine amount in difficult times. What was the share placing for?
Share placing was to enhance the Harmony IP service. Harmony IP is a new initiative that we've launched in September, October of this year. It's basically, instead of buying out complete rights, we take a percentage of either a writer, composer, or a band's income, a little bit like asset release on your house. So they're able to release up to 30% or more under negotiation, whereby we partner with them. In partner with them, they immediately get the benefits of TCAT investigating their background to their income. We can use it as an audit tool. We can see where the product's being sold. If it's not reaching every one of the 167 territories it should be being sold, we'll find that and place the product there, therefore enhancing the earnings. And we'll also look to make sure that everybody exploiting it is reporting. So there it becomes it's not really anti-piracy at that point. It may just be an audit and or copyright infringement tool. That's the attraction of both the Harmony IP partnership with us, and they get TCAT thrown in as a service because they're now partnering with One Media.
And how's the Harmony IP business coming along? How is it developing? Do you have high hopes for it?
We've made a couple of strategic deals recently. We recently announced the 21 Vision deal. We announced also the Take That producers royalty acquisition. These are done under the Harmony initiative. We have many more in the pipeline. I think one fallout from the pandemic is because we're typically dealing with a slightly older generation that getting physical meetings with people over the last 5 or 6 months has been obviously a little bit more difficult than normal. But they're slowly adapting to doing Zoom and not actually sitting across the table. And we have a very strong pipeline that we will be delivering during the remainder of this year, calendar year.
Okay, let me look at the core business. You buy and exploit music royalties. What new deals did 2020 bring? Not the ones that we've just touched upon, but what else did 2020 bring, and how did the core business perform to October?
Core business done well. We as I say, during the period under review, very little of the income is delivered by acquisitions made in that period because we didn't make that many. So core business is growing in a strong, robust way. What we like about our business, and I think what we need to introduce to investors, is that the music industry is becoming of age. We've seen much hurrah to some of the very major companies like Hypnosis and Roundhill and people like that that are investing heavily in music rights. So there's been a little bit of a gold rush to our industry, and I'm that doesn't bother me in the slightest. Competition is good, but of course they're much larger than One Media. We're much smaller. So what we're really seeing here now is a focus that investors can begin to use the music industry as a reoccurring, robust industry, as opposed to perhaps the risk business that it might have been several years ago. I think now we're beginning to see a serious investment coming in. We ourselves have got a number of core investors that are big institutions that we're very proud to have and boast as being investors. So I think we're coming of age as an industry more so than just a business.
That's very interesting. By their nature, results are backward looking. So what's been happening in terms of current trading, Michael?
Current trading continues very much, to market expectation. I mean, there is a broker's note out today. If people want to look at the Senkos site, they'll draw down the feelings of the market, or dare I say, the analysts, and they can take a look at what we believe in, and clearly they believe in the way that the businesses are going. So it's continued growth. I think it's continued profitability. We're a cash generative business, which is an interesting different to a lot of industries. We're cash generative. We've declared a dividend, and we just see more of same, onwards and upwards.
Okay, what does that dividend say about the stability of the business, and what's your dividend policy going to be going forwards?
Since 2009, we introduced a dividend policy. We only rested that dividend policy during a period of time when the music industry was actually dropping down. And that was largely due to the fact that the physical formats and music downloading was dropping in the face of streaming coming back up. So we saw the downloading market dropping, streaming picking it up, not picking it up as fast as it was losing it. Now, we saw this years ago with the CD market, when the CD market dropped and downloading first introduced. So the resting time now has begun to prove that we're in a far more robust model. We reintroduced the dividend last year. We have a very strong policy of dividend. We want to continue that. And for as long as the business continues to grow, the dividend is absolutely firmly on the table. It's modest at 0.055. But again, if the model proves proper, then we're not ashamed to say that is something that we heavily focus on for investors, to reward loyalty, because as a small business, share price is always the big thing. Can you buy one media shares and trade them quickly and fast is always a difficult thing as a small company. So dividend is a reward for long-term holders.
Okay, final question, Michael, which flows very neatly off the back of that. Why should investors follow you, hold your stock, have you on their watch lists?
The industry, as I said, is coming of age in terms of it going from just being a music-based business to suddenly become something which is more bankable. Its robust recurring income is the most important part of what's going on. Last year, under review, a music industry was worth $20.5, I think it was, billion a year in turnover. The forecast for this over the next 9 years are to take it to 40 billion. So we're seeing a doubling up of the music space and incomes that are earned. So players within it are set to grow. You just need to make sure you're in the right place and have the right model. And dare I say it, a very steady hand on the tiller and not follow trends and fashions too quickly and overinvest and overspend. We're quite risk adverse on that front.
Michael Infante, thank you very much indeed for joining us today. That was really fascinating. Thank you for taking us on a journey through your business.
Pleasure. Very much.
That was terrific. Thank you so much. For more interviews like this one, please subscribe to the London Southeast YouTube channel and do follow us on Twitter @London Southeast. Thanks for watching and do stay safe.